And finally, U.S. consumer prices increased by the most in more than a year in August. The consumer price index increased by 0.6% last month. Now, this is the largest gain since June of 2022. So year over year, the CPI jumped 3.7%, which is also higher than July. Some economists believe inflation risks are leaning to the upside potentially. This is because of rising insurance costs, especially for motor vehicles. A strike in the automotive sector could also disrupt supply chains and boost motor vehicle prices if it lasted more than a month. And here with me to talk about the CPI report is Sam Burns, Chief Strategist at Mill Street Research. So good morning, Sam. Today's CPI report, definitely not something to celebrate. Gasoline or energy prices contributed the most to the uptick. Any worries in your mind that this inflation battle could last longer than we think?
Well, I think, yeah, the Fed is certainly going to be hesitant to declare victory on inflation anytime soon. So I think they'll keep up a certain amount of hawkish messaging. But I think the overall trend in inflation, and certainly the things that the Fed has any control over, are still in kind of a downward overall trend, even though there's a lot of noise in the data. So I think the structural trend is still there, but it does, kind of complicate the Fed's messaging a little bit.
So the uptake this month and last month as well. So these past 2 months, there's not really much there to talk about?
Overall, no. I think this month was mostly due to energy prices and even flowing through to things like airfares, which are directly, closely tied to energy costs. And those are things that the Fed typically doesn't think that are worth changing policy for, meaning that they can't affect OPEC. And really, OPEC is the reason why oil prices are up and why fuel costs and airfares and things like that are being influenced, because they've restricted supply, and that's really a political decision based on what OPEC is doing. It's not anything that the domestic U.S. monetary policy can really affect. I think a lot of the more domestic things based on consumer spending here and things like that are still in the kind of a disinflationary trend. Most goods prices are still falling or flat. And I think the housing costs are going to be going down, slowing, I guess, over the next, say, 6 months as kind of the CPI catches up with what we know about rents. So I think those factors will continue to be downward pressures, and the energy costs will be sort of a variable, but it's not something the Fed can directly control.
I see. So you're still convinced that the trajectory for inflation is still downward?
That's right. I think the general trend is still disinflationary. I think the growth in labor income is still positive but slowing. Bank credit has slowed quite a bit. So a lot of the domestic factors that tend to drive inflation are still pulling back. And because we know about the lags in the housing market data, we know that housing costs and rents have slowed quite a bit already, and the data will be reflecting that. So a lot of the things that are harder to measure, like education or healthcare, or financial services, those tend to be where a lot of the noise comes from in the inflation data. But I think that the longer term trends there are, again, kind of moving in the right direction overall.
Speaking of the lag in rents, I would have thought, it would have shown up by now, but it seems like it's taking longer than I think.
That's right. It has been a little bit of a bumpy ride. I mean, the rate of change of rents in terms of the owner's equivalent rent and the rental costs that they use in the CPI have turned down, but they're still much higher than actual rental changes on a kind of a more real-time basis are. And so because they have roughly a 12-month lag historically, because if you think of somebody signing a 12-month lease typically on a rental housing unit, that's kind of the lag that's embedded in it in many ways. So it will take 6 to 12 months for the CPI data to catch up to what sort of current market rents are, and that's what we're seeing now. So that's why I think over the next, say, 3 to 6 months, we'll see more of that, because we know that the current rents are not growing as fast as what the CPI says right now.
So how is the Federal Reserve looking at this report? Does this report change anything?
I doubt it changes anything major. I think that they're still going to hold rates steady at their meeting this month. The market is kind of pricing in some chance that they do a November or December rate hike. My guess is that they'll probably find a reason to avoid that, but they'll keep their messaging on the hawkish side. So I think they'll kind of talk about staying tight more than they'll actually act. I think they realize they've already done a lot of tightening and that rates are already quite high, and that as reported inflation continues to kind of ease, then their policy rates will still look high relative to reported inflation. So I think they've realized they've done quite a bit already. They don't really need to do more, and there's not much they can do about things like OPEC and oil prices, and so that they'll try to avoid responding to fluctuations in oil prices and things like that. So that's why I think they'll probably try to keep it steady if at all possible.
Just a side comment here. You know what I found interesting is so Jerome Powell spoke at the Jackson Hole summit recently. He said that inflation is partially caused by the war in Ukraine, but I noticed that he didn't mention the trillions of dollars of stimulus injected into the economy. And what's funny is that, Sam, if you think about what Russia's war in Ukraine impacts, it impacts energy prices, right? And that's the thing that the Fed doesn't look at. So how can you say that the war in Ukraine is a bigger factor than to inflation than the liquidity injection? What are your thoughts on that?
Well, no, I think it's true that both have had a big impact, and I think it was more that in the first half or so of 2022, right after Russia invaded Ukraine, there was a huge spike in oil and natural gas, but also things like wheat, where the production from Ukraine and Russia was interrupted. So I think there was a big sort of sudden spike in inflation that was caused in part by Russia invading Ukraine, and that has now since faded. So I think it was more of a historical comment saying that there was a big impact from it, though it is now kind of eased because outside of what OPEC has been doing, oil prices have come back down a lot, natural gas prices have come back down, and a lot of the food prices, commodity prices have come back down as well. So the stimulus, I think, is a bigger picture, longer term driver. And so I think to the extent that they refer to fiscal policy, they also view that as not their purview, but it is something they have to respond to. So they can't affect the stimulus directly. They can't lobby Congress or do anything like that. But I think they are keeping rates maybe higher than they would otherwise because they know that that fiscal stimulus is still there and came first from COVID and now from more of the infrastructure-related spending that they're doing.
All right, just one last comment maybe from you. What has been the reaction by the market to this inflation report?
So far, I'm just looking at my screen now. Basically, not much reaction. Bond yields are roughly unchanged from where they were yesterday. The dollar is a little changed. There was some spike initially on the news, as there often is, but now stock prices are, up slightly on the S&P and down a little bit for the small caps. But basically, I think it's generally in line. The headline and core numbers were very close to what economists were expecting, and nothing about it really changes the overall view on rates or inflation. So I think the markets have kind of viewed it as a roughly in line number, nothing to respond to much, and we'll go back to focusing on other things.
Well, all right. Thank you so much today, Sam. Always a pleasure.
My pleasure. Thanks for having me.